Michael, this is such a joy to do. Obviously, I heard so many good things from our mutual friend Bill Gurley. I've read every book that you've written. So thank you so much for joining me today.
Thank you, Harry. I'm really pleased to be with you today, and I'm a big fan of your podcast.
That is very, very kind of you. I can't believe I actually get to do it for a job, to be honest. But I want to start with you. You're a celebrity in venture circles. And I want to start with a question from Bill Gurley, which is like, what do you do, Michael, and how do you spend your time today?
Yeah, exactly. Well, my title is head of Consilient Research for Counterpoint Global, which is part of Morgan Stanley Investment Management. We're a long-only investment management firm, also have ventures investment fund as well. But my job is really three parts. One is to work with our team on investment process. So things like how do we think about markets? How do we think about valuation, competitive strategy, decision making? The second part of the job is really doing research, and that is thinking about topics and writing about them. And then finally is external things like conferences or podcasts or things like that. And the way I like to describe what I do is input and output. So try to find something that's interesting, spend some time to understand it, and then communicate it both internally and externally. So it's for me, it's a very fun and gratifying job, and allows me to pursue a lot of interesting things.
You say about input and output there, and that makes me think about kind of decision making and process. But you've said some brilliant things before, especially on kind of luck and randomness. And you said randomness and luck are related, but there's a useful distinction between the two. What's the distinction between luck and randomness,
Yeah,
Michael?
it's a great question. I mean, let's start by defining luck. And by the way, this gets into philosophy very fast, but just to try to be practical, I'm going to say luck has three conditions. It happens to an individual organization, so to you or your company or your favorite sports team. Second is it can be good or bad. Don't mean to suggest that it's symmetrical, but there's a positive sign, potentially, and a negative sign. And then third, and this is important, it's reasonable to expect a different outcome could have occurred, right? So if we replay the tape of time, reasonable to expect a different outcome. So the way we think about randomness versus luck is randomness would be at the system level and luck would be more at the individual level. So for instance, every year in my class, I do a little exercise to demonstrate this point. I flip a coin and I ask the students to guess whether it's going to be a head or a tail, right? We do a bunch of them in a row. So what I know is, given the size of the class, that someone's very likely to get 4 or 5 in a row correct. The coin tosses themselves, assuming I actually do it with a simulator because I'm so bad at it, but the coin tosses themselves, I'm going to deem to be random. But if you're the one that calls 4 or 5 in a row correctly, I would call that luck. So one would be system level, one would be more individual level. And so when you think about investing, there may be a lot of randomness in the system, and some people are going to be in the position to be lucky, and hence their track record, for example, may look good as just beneficiaries of a random system.
I love that as a distinction. You said before, as kind of a follow-up to that, well, my natural kind of question was, why does putting yourself in a position to enjoy good luck, what everyone obviously wants, why does that put you in a position to lose?
Yeah, I mean, the first thing is I'll just say that there are like a bunch of aphorisms about luck. You know, luck is where preparation meets opportunity, or the harder I work, the luckier I get. And I don't really find any of those very appealing, candidly, if you accept my definition of luck, right? Because in another way of thinking about it is that, skill is what's in your control and luck is what's out of your control. So by definition, out of your control. Now, that said, Harry, I think that, what you're picking up is on something like this. You say, oh, my friend won the lottery yesterday, right? And we'd all agree, I think, that was lucky. Now, you would not be in a position to win the lottery unless you buy a lottery ticket, right? So in a sense, you have to be willing to lose in order to potentially win. The fundamental question it all distills down to is it positive expected value or negative expected value, right? So, and investing by and large should be obviously positive expected value. Playing the lottery by definition, or gambling, is a negative expected value. As a consequence, people should be, that they should do it for fun if they would like, and there may be other psychic benefits of it, but just in pure monetary pros and cons, it's going to be a negative game.
Can I ask, where do you find people most misunderstand this theory and this understanding? Where do your students misunderstand it? Where do you hear people just not get it?
Yeah, I mean, I think that because it's about attribution, right? In other words, if things go well for me, I want to think that I'm skillful, it's like volition, that I'm the one that's responsible for it. And if things go badly, I want to point the finger at somebody else. So I think a lot of it is just sort of taking responsibility for all these things. But even taking one step back, Harry, I would just say that it's not always clear, various activities have various combinations of skill and luck in determining the outcome. So you think about things like chess matches or running races, That's almost pure skill, and luck plays a very fleeting role in those kinds of things. By contrast, we already talked about, lotteries, but roulette wheels and certain those things are all basically luck and very little skill. And most things are at some between those two extremes. And I think our minds are not particularly good at sorting out where that activity is on that luck skill continuum. And as a consequence, it's misattribution, basically.
The thing I find interesting with venture is you can be lucky and attribute that skill to yourself and when it's actually luck, but actually it can make you a better investor, I found, because you lose your downside scenario planning. You see the best in things and you're not fearful of losing your money where others would be. I guess the question is like, does it matter, I guess, if you can attribute it to yourself and you become a better investor? I guess, does it matter?
I don't know if it matters, but venture is particularly interesting. One of the measures of skill, for instance, is this concept of persistence, which is, if you won yesterday, will you win today, and will you win tomorrow, and so forth. And so persistent activities tend to be indicative of skill. Interestingly, if you look across asset classes, the asset class that continues to have high persistence is actually venture capital. So the question is, why is that the case? And so it's a very interesting question, and I think there are some provocative potential answers to that. Well, one of them is this idea of preferential attachment, right? That once you could have gotten yourself, you could have made a few successful investments by dint of luck, but once those successes have occurred, people tend to preferentially attach to you as a venture capitalist. So you think of certain organizations, certain great venture capital firms, that if you are a hot up and coming company, and there's a presumption that people can figure that out, you're going to preferentially attach to the big names on the venture side, and that becomes this feedback that allows the sort of top firms to sort of differentiate themselves from others. And what we know is that there's huge dispersion in returns in venture capital. So if you own the top decile or top quintile type of firms, you do spectacularly well over time. But if you own the median firm or a bottom quartile firms, the results are actually quite dismal. So venture is a particularly interesting, because the question is sort of what are the mechanisms that contribute to that persistence? By the way, that persistence used to happen in buyouts, but that effect has mostly melted away in the last 20 years. And it's very difficult to find persistence in public markets at all. So that's a very interesting topic, broadly speaking. And so, but the key is to be a little bit circumspect, which is, if I'm successful as a venture capitalist, for example, how much is the name on the door, and how much as me as an individual sitting in the seat who could take the phone calls and take the meetings and hence allocate the capital.
100%. I think it's the challenge that all spin out GPs face when they try and raise their own funds. But when we think about that, though, then is investing in or building a company on a novel premise, is that a luck-based endeavor?
I don't think so. Of course, I think that what you strive to do is to develop a process that you think will allow you to have the most best chance of success over time. And one of the things I would just say, Harry, about building a process is the first thing to think about and think about deeply is actually what you're trying to do. Like, how do you think you're going to achieve some sort of an edge versus other people doing it? And in effect, the process you develop should be something that contributes to that source of edge. So for example, in public markets, you'd think about the two extremes would be, Jim Simons at Renaissance Technology, right? Tons of technology, very smart people trading very frequently. And on the other side of the continuum would be Warren Buffett, who purportedly sits in his office all day and reads and then makes these very few but very consequential investment decisions. Both of those folks have been very successful over time, but their approaches and their processes are very different. So the key is that there is no one size fits all for process, I think, but rather that you want to make your process congruent with your perceived source of edge. And so that to me is sort of the key thing to bear in mind. And it's often one thing people say, here's what I do all day. Usually when you're marketing your fund or something, there's a little bit of aspirational component to what you say you do. But the key is to be as congruent, to do actually, to hew as closely as possible to that process in order to achieve the results you pursue.
The brilliant thing about me doing this show is I can just ask for your advice and feedback. So if we think about process being congruent with edge, my edge, I believe, is that we are the true intersection of a media company and a venture fund. We leverage media to be the best investors. How does that impact my process? Through the media, I meet the world's most brilliant founders. And with each deal, I create an individual investment committee of 3 leading founders in that specific space, and I bring their collective minds to make the best decisions together. Would you say that is where my edge is congruent with my process?
Absolutely fabulous. And other things you like to see in a process that's good would be things that it's economically sound. Now, the fact that you're tapping these founders, they have some experience, that would be important. The other thing to say is that your process should be allowed to evolve. And in some ways, I would say that there are mutable and immutable components. Immutable things where certain standards you want to maintain, and sort of objectives you want to pursue. But mutable is, hey, the world changes, and we need to make sure that we're updating our frameworks and mental models to accommodate that. You also want to build in techniques to manage or mitigate bias. I mean, you mentioned that just a moment ago. And so it's interesting you said a group of 3. 3 is a really good number for decision making, and because it's an odd number, right? And so you can have
do you know why I did it though? Because I used to do it with 2, and people don't feel free to discuss with 2 because they feel like they're in an argument.
That's
with
right.
3, it's a discussion. 2, it's a really heated debate.
Right. And the other thing about 3 is, if it comes down to it, you can actually have a 2-to-1. People can vote, and it can be 2-to-1, and you can proceed without, you can have the dissenting voice be in the room in a way that's not ultimately destructive. And the last thing here is you want that to be repeatable. So in other words, you say, hey, I've got this formula. Here's what I'm doing. Here's why I think it's delivering on this edge I'm pursuing. But you want to be able to repeat it over time, right? So the more you do it, the more we want this to be something that's just not a one-off, but it's a process that works over time. So yeah, I mean, certainly that all makes sense to me.
Can I ask you, what makes bad process, or where do you see most people make mistakes in their process?
Yeah, I mean, it's usually 2 things. One is a deviation from what you say you're trying to do, right? So you just laid out kind of how you're approaching it, this combination of media and venture investing and so forth. The question is, are you starting to do things that deviate from those things? Or you bring in these 3 founders, your little investment committee, and they really have expertise and different points of view, and you override them for whatever reason, right? So you just depart from process in a way that's non-systematic. And by the way, it's not that hard to do, because sometimes you may have a process and you have a couple things that don't work out, right? Which is going to be naturally happening. So you start to question what you're doing, so you deviate. That's one problem. The other one is just letting biases creep in to what you're doing, right? So biases would be things like, and these you may be emboldened by success, by the way, but 2 big sources of bias, I think, are, one is overconfidence. And when you look at overconfidence, usually the subcomponent of overconfidence, the problem is overprecision, which you start to think you know what the world is going to be rather than better than you do. And the other one is confirmation bias, which is sort of, when you have a view of something, you have a thesis, you start to seek information that confirms your point of view and dismiss or disavow or discount information that is not what you believe. And that can be problematic in terms of your updating your view. So anyway, those would be 2 things I would point out that would be to be careful about.
So this is why I don't like thesis-driven investing, if I'm honest, Michael. It's because you develop a thesis in your mind, you meet a company that aligns to that thesis, and you go, yes, that is the one. And then you're going, well, there's probably a 50% chance that your thesis was wrong, but confirmation bias has made you commit to that deal. How do you think thesis-driven investors can not fall victim to confirmation bias and that situation I just laid out?
Yeah, no, right, exactly. I think this is a really big issue. And the biggest thing, the way I would think about this is to say, if you do have a thesis, and by the way, I'm not averse to that, but if you have a thesis, you should be thinking about so-called signposts, which is to say, if this thesis is correct, here are the things that we should see happen as we travel down this road, right? And these signposts are things you should communicate in advance, not as we go, but in advance, and typically write them down, and you should write them down specifics with probabilities, right? And so if this is what we should happen. Every time you don't pass a signpost, or the signpost is something very different than what you anticipated, that should be a stop point. And the stop point should say, okay, is there a reason for this? For reasons it could be, or should we kill, right? Should we quit what we're doing? And so in a sense, you've laid it out in advance. You've laid out the potential problems, you laid out the potential opportunity, and so you're pre-committed to changing your course of thought if your thesis isn't unfolding as anticipated, right? So the key, Harry, is to do the work up front, essentially, and as a consequence, and think through the potential alternatives, and then that almost compels you. And then, by the way, I might even call you up, Harry, and say, I want you to be my decision buddy. We're friends, you like me, and you have my best interest at heart, but you're going to be honest, right? And so I'm going to say, oh, Harry, here's what happened. We thought this, and these 2-3 things happened. And you'd be like, okay, that's it. Based on what you said, that is not happening the way you thought. You should move on, right? Somehow. So you can also bring in people to help you, almost coach you through that decision to be honest and to change tack if appropriate.
I think there's two things which prevent the purity of decision making and process and freedom of speech in investment committees and decision making. One is politics, and two is safety. Actually, we have thousands of GPs and VCs that listen. How can GPs and investors create safety among their teams and among their investment committees where people can feel free to say anything without being judged or without being fearful that they're speaking to Bill Gurley? And so
I love this question, Harry. And I just say, when we work in teams, we always talk about 3 components. One is the size of the team, the size of the team. And you've got that, but usually smaller is better, right? And that the right number is between 3 and 6, something like that. The second is the composition, which is you want cognitive diversity, so people bringing different points of view. But the third piece is how you manage the meeting, how you manage the team. And I would just say that usually there's cognitive diversity in the room. Almost always where the failures occur is in how it's managed. So it's very much good hygiene demands that leaders of teams figure out ways to surface alternative points of view. And there are techniques to do that. Things like pre-mortems as an example. Thing is, if I'm the leader in the organization, to go and ask the opinion of the most junior person in the room first, and then go up in seniority from there. I mean, there are techniques to do this, but this is the problem, is usually people who rise to be the leaders, and you mentioned politics, it's exactly right. Whenever I talk about this and say like, well, the phrase is actually people defer to the hippo. You know this term? Hippo.
No, I didn't.
People defer to the hippo. Hippo stands for high income person's opinion. I like it. So if you've risen to be the hippo yourself, you have to be the one that manages this process to make sure that you're getting closer to hearing what's going on the ground. And by the way, often it's the case as you move up in the organization, you're further away from the actual on the ground, what's going on. And as a consequence, you have to be doubly mindful to be paying attention to that. So yeah, I think that good decision-making hygiene demands that the leader of the team puts into place these mechanisms to make sure that alternative points of view are surfaced. And that's where you get into this idea of psychological safety, as you point out, that not only am I fine with you saying something that's different than what I believe, I'm encouraging you to do that. In fact, I'm almost demanding that you do that to make sure that we have a robust and fulfilled conversation.
So the way I do it is I send out actually a Word doc, not a Google doc, because that's obviously collaborative. I send out a Word doc the night before. So it's all in isolation. No one sees what other people put. And then they have this kind of free space to really illustrate how they feel. And then I bring them all together. And then in the meeting, I can draw on that and say, Michael, you actually said you really didn't like this for that reason. Talk to me about that. And you wouldn't have probably said that if it was in a collaborative doc where people are chiming in. Are there any other ways that you've seen it really work and bring out?
No, that's fabulous, Harry. That's fabulous. And the other one, the other technique is known as a pre-mortem, which you're probably familiar with, which is we pretend we made the investment. It's now a year from now, or 2 years from now, and this investment's turned very sour, very bad. We're displeased with it. And then each of us writes down today why, basically the story from the Financial Times and Wall Street Journal that's published 2 years from now, why this didn't turn out well, right? So again, it's the same mechanism that you just described, which is you're encouraging people to think on their own why this, sort of what the downside is in these types of scenarios. And that, again, surfaces potential problems. We have to think about upside as well, but surfaces potential problems, which then we can identify and see, are these risks worth taking, and B, if some of these eventualities occur, how do we take care of them or deal with them in a way that allows the investment to continue to work out well?
How do you think about when's the right time to change process or just improve it in some ways? Like I said, when I had 2 people on my ICs, it didn't work, honestly, Michael. And then when I had 3, it was like product market fit of investment decision making.
Yep.
But I could have kept going with 2 and it just meandering in the way that it was. How do you think about when to change a core investment process?
Yeah, to me, I think it's, all this, you can do a lot of pre-work and get sort of best practices. And, 3 is better than 2. That's a best practice. And by the way, 5 is better than 4, for example. These odd numbers tend to be good things in terms of, and there's good data. Pardon me, there's good data to back all that up. But to me, the issue, so that get that hygiene down, that process down in terms of the best practices. The other part that's very difficult is literally how do we update our views of the world as the world changes? That becomes the big challenge, right? And that, the fancy term is to be an appropriate Bayesian, which is I have a prior view of the world. As new information tumbles in, I revise my view in the proper direction and the proper magnitude. That is the very difficult thing to me. So when does the world have to change? When does your process of change to reflect that? I'll give you one example, certainly in we do a lot of work on this in public markets, but are very relevant for private markets as well, which is we've had in the last few decades a huge rise in intangible investment, right? So companies used to invest in factories and machines and inventory, old-fashioned stuff, and the accounting for that was a certain way. Now companies are investing mostly in intangible assets, and the accounting is very different, right? So if I'm using a simple heuristic in my process of profits are good, losses are bad, I might be very much missing the boat. So I need to update my views. I need to update my process to accommodate the nature of the new investment. Now, it doesn't mean that just because you're losing money, it's good, right? You still have to get to the core issues. But that's an example of a process update that I think would get you a step closer to reality and economic truth.
My question to you is, you've said before about everything being a DCF, and as a venture investor, I went, that's an interesting thought, and we forget that our job is tied to DCFs ultimately. So can you explain this idea of everything being a DCF, specifically for a venture audience?
Yeah, so Harry, I got to say that the impetus to write that report was a venture capitalist actually sent me a note about value venture businesses. I was like, I don't really like it. So it encouraged me to write that. Listen, I think that the way I would think about this as a venture capitalist is not that I'm going to build some elaborate DCF model. Of course, that's very unrealistic given the wide range of potential outcomes. I think that for venture in particular, I would step down to what I call the basic, well, many people call the basic unit of analysis, which is fundamentally how will this company make money, and understand that. Now, obviously, sometimes we're going to build up to how the economic model is going to work, but it's really trying to get some clarity around ultimately what the economic model is going to be. So that economic model then becomes the foundation upon which the future cash flows are built. And when you think about the value of any financial asset is the present value of the cash flows. And as a venture investor, eventually we're going to have an exit. The number one form of exit, of course, is to sell to a strategic buyer. And when you do that, the problem becomes their problem. They have to figure out how to extract the cash flows from the business over time. Or if you go public, of course, then you continue to manage the business, and the market places its best judgment on the present value of the future cash flow. So to me, it comes down to the basic core is, are we investing in such a way that will generate appropriate returns? Those appropriate returns then will generate cash flows, and that's at the end of the day sort of the thing that guides all of our thinking. So to me, that's how I think about it. Now, the other thing I would just say about venture and some public companies as well is that there is a substantial component of optionality, so like real options, you could think about it that way, and that is something that one can take into consideration. And real options tend to be relevant when there's a lot of uncertainty, which is almost always true for young companies. Second, when we have an astute management team that knows how to cultivate and ultimately exercise options appropriately, when there's access to capital, which is also really important, and typically a market leader, because the market leader tends to have more alternatives than the second or third tier players. So that's another component, but even an option eventually becomes free cash flows. It all boils down to the same thing at the end of the day. So that's my long-winded answer to this question is focus on the underlying economics. That's all driven by cash.
I understand that, but let's go to pre-seed and seed. If we, I did Be Real, which is like a consumer social, very, very fast growing company, one of the fastest in the world. You look at any of the early days of a lot of some of the biggest companies, they had no idea how they were going to make money. They also had no idea the scale with which they'd make money. The strategy changed. I mean, everything is so uncertain. So I guess my point is there a point in actually doing these models or even thinking in this way when it could actually lead you to say no to something that could be amazing?
Yeah, I mean, the thing is that, look, even these companies where there's not, you're not generating revenues yet, or you don't know how you're going to monetize, there is a build it and they will come philosophy, right? Which is it's eventually, if we have Be Real, if we have enough users, there's going to be some way that we can monetize this in some way, shape, or form. If you believe there is no monetization ever, then you're probably not. It might be a fun exercise, but it's a labor. You're going to be using up a lot of capital without getting a return on the capital. So it depends what you're trying to do. So, you think about early days of Google, before they came up with monetization, they obviously came up with techniques to get a lot of people to use their search engine. But that can't go on forever unless you have some method to monetize, assuming that you're in business to make money in investments. So, which I presume most venture capitalists are, right?
Do you look at VCs today? I'm just fascinated. Do you look at VCs and see like 30 million price for like, two people and a dog in a garage with nothing, and go, what are these people doing?
Well, I mean, yes and no. I mean, the one thing I would say that, I found to be a fascinating, not surprising, but fascinating academic paper published a couple of years ago, where they looked at the distribution of returns for 30,000 venture capital investments. So these are individual investments. And then they looked at 15,000 buyout investments to look at the distribution of returns. And, in venture, I'll just say what everybody already knows. The majority of investments lose money, right? But a handful of investments make so much money that they more than make up for everything else, right? So the overall returns for venture over time have been pretty good, mostly because it's a few companies pulling all the freight for the whole thing. Now, that said, when you say, $30 million for two people in a garage, the key is even those investments that lost money were deemed to be positive expected value investments, right? They had option value, they had potential. We know in advance, so it's not how often you make money that matters. It's how much money you make when you're right. So on one level, it seems, if the ideas are not good or the people are not good, that would be problematic. But on the other hand, if it's a positive expected value, going into this, you should understand the distributions of the payoffs. And going into it, you should understand that even if you're really good at this, the majority of things may not work out from a financial point of view. But again, acknowledging that it's going to be a handful of things that are going to be very, very profound. It's interesting. This is going to sound weird, but one of the analogs I found fascinating is with horse race betting. So it turns out in the 1970s, almost all the bets placed were win, place, or show, right? So first, second, or third place. And these are very plain vanilla bets. Today, the most sophisticated bettors are betting on these exactas and these parlays, things that are much more sophisticated. They have much lower frequency of payoff, but much higher payoffs when they do pay off. And why I think that's interesting is the mindset is completely different. If you're betting win, place, or show, you're going to win at a higher rate, although you're going to win much less. If you're betting on exactas and parlays, you're going to win at a much lower rate, but the payoffs are much higher. Philosophically, psychologically, very different type of thing. So anyway, I think that's a very important observation, is to know the type of system you're dealing with, to understand the distribution of payoffs, and to acknowledge that sometimes it's going to seem insane to pay a lot, $30 million for two people in a garage, when that still may have positive expected value if that becomes one of the few things that really drive the value.
What worries me with venture is, with the increase in supply of capital, you obviously see increased competition and increased pricing, which obviously then reduces the size of your outcomes. If you come in at 50, not 10, that's a very significant return difference. And what worries me is we're going to see this denigration of venture returns, much more to PE-like returns. How do you think about that? And do you think that's fair for me to worry about that?
Absolutely fair. Anytime you see capital flowing into something, you should worry about returns. That's like a basic rule. And if you look at long-term public market equivalent, so this is how academics measure this, public market equivalent. For venture capital, it's actually been pretty good over long periods of time, but it's extremely episodic. So almost all the returns are earned in very short windows. One was around the .com. One was actually what we just went through in 2020 and 2021. And now we're back, we're probably back down to sort of PMEs closer to 1, right? So for venture, it's very episodic. So buyouts, by the way, have consistently been a little bit better than the private equity, been a little bit better than venture. They're much less episodic or dramatic, and they tend to chug along a little bit over 1 PME. So yeah, I mean, I think that you always should worry about that. And the other interesting thing is just taking a close examination at how companies are exiting, right? And so what's happened is, a generation or two ago, a lot of companies went public. for a lot of reasons now. Companies are not going public at the same rate. These are interesting questions as to how to think about exits as well. So the whole complex should be examined pretty carefully. And by the way, what you said about about venture is also true for buyouts, right? Same thing. A lot of capital going into that area, competitive to buy businesses and so forth. Now, for buyouts, it helps when the public markets go down. For venture, it doesn't help when the public markets go down, right? So there's a contrast because buyouts can then do stuff to buy things cheaper today than they could before.
Speaking of the episodic nature of returns there, Doug Leone told me from Sequoia, Harry, just never sell your winners. And, I took that very much to heart. And I didn't sell some winners at the time. That was a mistake. How do you think about position exiting, and when's the right time to take the chips off the table?
Yeah, I don't know if there's a good answer for that. I mean, part of it is at some point, if a company gets mature enough, you should be able to start to assess value in some way, shape, or form. You mentioned early on having these models might be silly, and I don't disagree with that. But at some point, if there's some point of maturation, and certainly if the company's gone public or even it's gotten some degree of maturity, you can start to think about values or ranges of values that you think are appropriate. And the answer is, yeah, when the company meets or exceeds that value you think is reasonable, then you should scale out of it. Now, I'm sympathetic to the argument is, this is work by Hank Bessenbinder demonstrates that in public markets over long periods of time, most companies, public markets earn returns less than treasury bill rates. And it's like a handful, less than 5% of companies basically drive all the value for the stock market. So that's the argument for latching onto the winners and holding on to them forever. The premise is that you can find them and you own them and you know which ones are going to be the winners. So that would be the argument in favor of doing that. So that's finding the whatever, Apples when they're turning, or Amazons or Microsofts when they're starting to emerge. Easier said than done, but that's the logic for holding on to winners.
You mentioned the very skewed nature of distributions to very, very few companies. It leads me to think, well, damn, maybe we're not very good pickers. Maybe we should just have 500 companies. And given the concentration of returns in such small companies, as long as you're in them, it doesn't matter because they're so much bigger than you could ever anticipate. How do you think about portfolio sizing in particular, and doing the 100 companies in a portfolio, and it doesn't matter as long as you're in that one, versus the Bill Gurley and the benchmark, very concentrated, 15 to 20 picking and the art of picking?
Yeah, it's a great question. And obviously a number of firms in recent years have pursued the prior strategy, just like shotgun, right? And by the way, in public markets, that's indexing. So you just own everything and you don't have to worry too much about the details, and assuming that overall it's going to work out in your favor. The firms like Benchmark, and you look at how small the funds are that they're raising, they're still raising funds with millions instead of billions. So an M instead of a B in front of it. That's really much more of it's almost, it's a craft, right? So they're really, they're very hands-on. They're doing a lot. They're working their network. They're really trying to help these entrepreneurs build their businesses. The question is, what is the capacity to do that? And the capacity is two sides. One is how many entrepreneurs really deserve that much time and attention, have businesses that are that attractive. And then on the supply side is how many venture capitalists have the capital and the skill set to help them develop. And my guess is that the capacity is not as big as a lot of people think. So there's going to be a bottleneck in terms of how many firms can actually do that at a very successful level. And this is sort of Series A, really adding value at the Series A level. So I think the more the scattershot philosophy can be later rounds, probably is where you're going to see more of that type of thing. So that would just be my guess. It's not my area of expertise, but that would be my thought, is to think a lot about that capacity issue. And when you get to early rounds, there's just it's hard to stuff a lot of capital into these early round businesses.
It totally is. I do have to ask, you obviously, coach many people, you have students. This is unprecedented market times. And you have a lot of young investors going, oh shit, am I any good at this? I thought I was, but this is a very new world and this is uncertain times for someone who's never done it before or seen it before. How do you advise younger investors looking at the markets today, questioning whether they're any good?
Yeah, I mean, well, it's sometimes hard to know if you are any good. The key is, are you sticking to your process and trying to think about things the right way? And in markets like this, there are a couple tendencies that can be, I mean, it depends what you're trying to do, but there are tendencies that can be problematic. One is to focus a lot on price swings. And price swings can, but both on the upside, by the way, and on the downside. So price swing, you might think that upward price means that you're smart, and downward means you're okay. So try to focus less on that. And then the second thing is people tend to focus on macro events, right? So, oh, here's what the Fed's going to do, and here's what inflation's going to do, and here's what interest rates are going to do, and so forth. There's a large literature demonstrating that people are not good at forecasting those things. So it's not to say that you shouldn't be aware of them, or you should not think about how those things might affect your business or the businesses you're looking after. But by the same token, sitting around and spending a ton of time on macro, from my point of view, is not great. So then the question becomes, what are we trying to do? And the key is we're trying to buy stakes in businesses. And that actually, at the end of the day, is being a business analyst. And so trying to keep people focused on the thing that they can control, the thing that they can understand. They need to be aware of these other factors, but the ultimately focusing on the thing that is core to the mission. So yeah, that's usually the advice. And the other thing, it's funny. I was just visiting with a bunch of clients and prospects and so forth, and everyone was like, "Oh, this is unprecedented times and uncertainty and so forth." So I tell them the story that I started on Wall Street in the mid 1980s, and about 13 or 14 months into my training program was the crash of 1987. I was a trainee, so we were expendable. So I was sent to the margin department. And by the way, this is obviously pre-internet, really pre-faxes. We were sending Western Union telegrams to people. Dear Mr. or Mrs. Jones, you owe $5,000 in your account, margin call. What I like to emphasize to people is the crash of 87 was the end of the world, right? People don't realize that was really bad, right? People were completely freaked out. It was stunning. We had seen nothing even remotely like this since the 1920s. And then I would encourage you now to look at a long-term stock price chart and go find the crash of 1987 on there and look at it and see like how significant it is, right? So at the time, it seemed to be very profound. At the time, it was earth-shattering, and now in retrospect, not that big a deal. So, at some point, 5 years or 10 years from now, will we look back on today and say, oh, it was challenging, it was bad, but look, we've advanced and the world has moved on. So that's the other thing, just to have a little bit of perspective of history, to say that everything seems very dramatic in the moment, but given the benefit of time, the impact tends to dull.
Can I ask, what was the recovery like for 87? And is it right that, we enjoy long periods of good times, and actually the bad times, we spike out of them much quicker than we have the good times? Like the recovery is fast paced.
Yeah, and I think what happened, I think that was what was unanticipated, was that 1987, that the economy continued to do fine. So the stock market actually ended up okay for the full year of 1987, and actually was okay for 1988. So it ended up being a shock to the system that did not, undermine the underlying economic conditions, and things ended up being okay. But you're making a really important observation, which is, there tends to be, the upside tends to be more gradual and the downside tends to be more dramatic. And that is true. And that's difficult psychologically for people as well. So that is a basic pattern. The other thing is interesting is that, we talked about randomness before. The random walk would say that randomness is sort of like there's an equal distribution of like shocks in the system. But empirically in finance, we know that's not true. That we know that volatility and shocks tend to come in bunches, right? So you get quiet periods interspersed with periods of great volatility, then quiet and volatility, and so forth. So what we're going through in public markets today is just that, which is you're going to have these violent days on the upside and violent days on the downside. This is the volatility cluster right now that we're living through. We will come out of this at some point, it'll get quiet again, and so forth. So just understanding these patterns and having lived through them before, understanding what they're about, and recognizing that, ultimately this too shall pass. And that's important for people to have that perspective as they think.
I think one thing that worries me is, unlike maybe prior financial crises where you've had like bluntly financial mismanagement or wrong decision making, here I think so much of where we're at is because of, a health pandemic in COVID. We have political conflict and, a potential war that, shakes so much of supply chains. What worries me is the instability of the world, not just financial markets. And does that make sense? And it feels like it's the first.
It does, but again, go back to 1900 and look at the history from 1900 to today, and just ask yourself, oh, with pandemic 1918, we had 2 world wars. I mean, we've seen versions of all these things over 125 years, right? So on some level, it's always novel. It's obviously massively disruptive. Like you said, I mean, we've had more globalization in the last 30 years, and as a consequence, supply chain effects are greater. But on some level, we've seen versions of all these things in the past. And so again, it always feels dramatic in the moment. And it is. I'm not saying it's not. But I think we have seen things like this. And by the way, on volatility is an interesting one. Go back and look at volatility, and you see that the volatility we've seen in the last 10 or 15 years, even including the financial crisis, really doesn't hold a candle to the volatility we saw in the 1920s and 30s in the United States. There was vastly more volatility in stock prices. So yeah, on the one hand, it's always novel, it's always scary. On the other hand, when the sweep of history, this is not inconsistent with things we've seen before.
Final one, I promise. We mentioned the volatility on the value reshuffling that we've seen in public markets in particular. Everyone's like, I can't believe it. This company is, 4.5x ARR. What is going on? And my question is like, is this actually just the new normal? And was it incredibly buoyant markets before that was unrealistic and irrational? And this is the new normal, or is this a down period? I'm not even sure if this is a down period.
It's very interesting, Harry. You mentioned COVID before, and just to dwell on that for a moment, I think COVID was a huge challenge for a lot of companies, right? In other words, for many young companies, there was demand pull forward. And by the way, if you don't have even if you do have a seasoned management team, it's difficult to manage through these things. And then you had sort of a regression back to more normal patterns. And so it was a very difficult period to manage through. And by the way, even like, world-class companies like Walmart and Target, which have really good managers and so forth and lots of data, they stumbled through, Amazon, these guys all stumbled through this, right? And they're still kind of coming out the back end of it. So just to be clear, that COVID, a one in a century type of event, created a lot of management challenges. Now, the flip side is when you talk about valuation, there are really a couple issues that are important. One is in equities, we have this idea of implied duration, which is, when am I getting my cash flows? And for a lot of younger companies and more growthier companies, the cash flows don't come until many years into the future, right? So we're paying for the future to some degree. That creates sensitivity to interest rates, right? And so, when the United States, for example, we went from on the 10-year negative 100 basis points real interest rates, negative 100 basis points, today about 140 positive basis points. So it's a 240 basis point swing in real interest rates. When you have long duration equities, there's no place to hide. And by the way, that rise in real rates, there's been no place to hide at all in 2022, right? Whether you're in credit or equities, everything's been marked down as a consequence of that. Now, the flip side is, in terms of discount rates, there's also a nominal piece, right? And the question is, companies can be, so you can't dodge the real rate increase, but you can dodge nominal rate increases if your company has pricing power. So this goes back to when we think about technology companies or any kind of company, are they delivering a good or service that creates consumer surplus? And if they're doing that, they have either pricing flexibility, or they can continue to delight their customers with their product or service. So thinking a lot about, does this company create value above and beyond their price that creates some consumer surplus is really important. So yeah, I think that there's, in some ways, that when you say like there was some inevitability, if you said to me, real rates are going from negative 100 basis points to positive 150 basis points, for instance, I would just say this is not going to be good, right? It's not going to be good for long duration assets, bonds or stocks. On the flip side is, maybe we're getting back to a more normal, in quotation marks, condition, right? Historically, both real rates, even nominal rates, but real rates are way below where they've been historically, and probably where they should be. Al Rappaport and I did a revised version of Expectations Investing, which came out about a year ago, but our final work was done in the fall, September 2020. So almost exactly a little more than 2 years ago. The 10-year Treasury note yield in the United States was 90 basis points. It was below 1%, right? That was 2 years ago. So are we just going back to more normal conditions? And that probably on balance is going to be a healthy thing. So again, those are just, I don't want to justify anything, but these are the ways, maybe some ways to think about these things a little bit mathematically to maybe take a little of this thing out.
Michael, I could talk to you all day, but I am aware it's a quick fire round time. So I'm going to say a short statement. You give me your immediate thoughts. Does that sound okay?
It does. It does.
It's coming to the incredibly unfair moment when I ask you. I love also your background and then my background. Like books, nothing. What's your favorite book, Michael?
Can't give you an answer to that. No, I'm just kidding. There are too many, but the one I would say probably is, I mentioned I'm a head of Consilient research, is a book called Consilient by E.O. Wilson. E.O. Wilson was a famous biologist. He died recently, but Consilient is about the unification of knowledge. And the argument that Wilson made that I'm very taken with this argument is that much of science is advanced through reductionism. So breaking things down into their components and understanding how they work. And many of the wonders we see around us are the consequence of that. Consilient is the unification of knowledge, and the argument he makes is many of the vexing problems we have in our world will require combining different disciplines together to try to solve them. So to me, Consilient, and I've been very involved for the last 25 years at the Santa Fe Institute. SFI is also very dedicated to this kind of a concept. So Consilient would be my book.
Can I ask, what do you think makes Bill Gurley so special and the incredible investor that he is?
So I think, first of all, he's very bright and he's very intellectually curious. And it is interesting. So I met him right when he got out of business school and joined. We were in the same research department. And right away, I could see, I started talking to him about certain frameworks and ideas, and he immediately not only understood them, but integrated them. So two big ideas. One is he understood, we were talking about DCF and everything's a DCF model. I think he's very early on understanding the importance of return on capital, investment returns, cash flows, and he applied it right away, very successfully, by the way, in investments. The second is he was very early on in understanding Brian Arthur's work on increasing returns, understanding the mechanisms of increasing returns. In economics, we're taught that returns on the margin go down, decreasing returns as a consequence of competition and maturation. But under certain circumstances, you get these increased returns. So he was very early on. So, and by the way, not only a good investor, but also a very good communicator. So he writes very well. And, you anytime you see or give it, see the talks that he gives, they're very thoughtful, very well prepared. So yeah, it's a combination of all those things.
What's your biggest strength and what's your biggest weakness?
So if I had to, I don't like this question at all, but if I were to say strength, it'd probably be curiosity. Just I am curious about the world. So I enjoy reading things and learning about things. And it's remarkable, even when I do research today, we're going to publish something, we're about to publish something. By the time this comes out, it'll be out. These are things we've written about before, and I learn an enormous amount doing them for the second or third or fourth time. So curiosity probably is my answer to that.
And your biggest weakness?
Oh, weakness. That's too long a list. That's a long list. But I would say probably the problem is that I gravitate toward abstraction versus concrete. I try to be concrete in what I do, but I probably am too high a level all the time and should probably be more grounded.
What's the best investment advice you've ever received?
This is, this too shall pass is the best investment advice. I think people get very caught up in the moment, by the way, on things being too good or things being too bad. And the key is just to sort of maintain this equilibrium. This too shall pass.
If I gave you $100,000, what would you do with it?
I would probably just invest it in the stock market. I think that, when you look at even 2022, expected returns for equities have gone up a lot. I don't know if the markets are going to be good the next month, 3 months, 6 months, but I think that expected returns look pretty good. I would just put it probably in the stock market.
What mistake have you made in the investment world that in hindsight you wish you hadn't made?
Yeah, I mean, those are easy because you just look at things that turned out badly. But I'll mention one investment, which is I bought Sears Holdings. Eddie Lampert was a CEO, and I knew Eddie a little bit at the time. I really liked the way he thought. I liked what he was trying to do with the business. It ended up being turned out very badly. I'm not sure it was a mistake in the sense that it turned out badly. But it's interesting because I liked his process, and I was saying I'm going to make a bet with the guy. Didn't turn out well, but that would be one example.
Did that impact your decision making?
That he was a good guy?
know that like does it change how you assess people?
Well, yeah, I mean, this is another one where this is that the Buffett, likes to say, or no, actually starts with Peter Lynch, I think, where he say, when a business, a challenging business, and when a business and management. So if a challenging business and brilliant management, it's likely the business's reputation remains intact. And I think that was a good example, which is I really like the CEO, but the business itself was challenged, and the reputation of the business remained intact. So that's always a good lesson, is that even great managers or even thoughtful managers, if they're managing a very difficult situation, will have a difficulty doing well.
Michael, I know you're committed to exercise and sleep. What are the exercise and sleep routines look like?
So I'll say, Harry, that my wife and I have 5 kids, and so the kids are out of the house now. So when they were growing up, it was very difficult to maintain all those things. Now, as a basically empty nester, it's great. So I'm very religious about sleep. I read, as many people did, Matthew Walker's book, Why We Sleep. It should be Why We Should Sleep More. And so I'm very religious about 8 hours and try to really stay on that program. And that for me is a huge cognitive lift. So for that's really important. I basically exercise every single day. So I grew up as an athlete, played a lot of sports in high school and college, and basically work out every single day. So I'm very those are 2 things that are very important to me, and they really are important to my performance.
Why We Sleep, that was depressing. It's like, you will become obese, you will die young, blah blah blah. I was like, what,
Alzheimer's, right?
let's put this to one side, Matthew. Thank you for your wonderful wisdom. Final one for you. You've achieved so much, Michael. What does success look like for you, and why do you still do what you do? That was from Bill Gurley.
Yeah, I love what I get to do, and I'm very blessed. Dennis Lynch is the guy that runs our team at Counterpoint Global, and Dennis is a great person to work for and work with. And so I have a job that I get to do. I get to do what I love to do every single day. I hope that hopefully that it's contributing something to the world. And there's a sense of independence and autonomy that's very powerful for me. And by the way, I said this, I will never, as long as I'm useful to somebody, I probably will never retire, because I have way too much fun and intellectual stimulation doing this. And I'll go back to what I mentioned before. I think that the key for me is this idea of inputting and outputting. And by the way, that's a big part of the teaching I do as well. So I teach at Columbia Business School. That output also that shows up there. So always learning. And by the way, I really believe this passionately. I think the best teachers are great students, right? The best teachers are great students. They're constantly learning about their topic, the nuances, and how to communicate in an effective way. So to me, it's that input output, which hopefully will go on for as long as I'm around.
Michael, this was such a joy to do. I can't thank you enough for agreeing to it. And really, it's been a pleasure.
Thank you very much, Harry. It's my pleasure.
You are a star, my friend. Thank you so much for that.